Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Zomedica stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Zomedica develops and markets pharmaceuticals for pets. The company's headquarters are in Ann Arbor, Michigan, and was founded in 2013. It went public in 2017 and currently trades on the NASDAQ. The company created Truforma, which will help vets diagnose pets in under 20 minutes. Zomedica has no patents of its own. It does have 4 applications pending. The entire diagnostic market for animals should reach $2.8 billion globally by 2024. This is according to Zomedica. Americans spend nearly $100 billion on their pets annually, $30 billion of that on vet care. Let's get started with the model. This is a mid-cap company, $2 billion market cap. They're trading at $2.12 a share, and they have 947 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. The company's pre-revenue, so they have no revenue. This is the company's income statement. The top line is the revenue, the sales. Below that is their operating expenses. Examples of operating expenses are research and development and depreciation. Below that is operating income. Below that is their interest payments. And below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Then the bottom line of the income statement is their net income, and that's negative every year. It was negative $8 million in 2017. In the trailing 12 months, it's negative $16 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Since the company has negative free cash flow, it needs money from somewhere to run its business. The company uses capital stock to run its business. It issued $15 million in 2019 and $3 million in the trailing 12 months. Every time a company issues capital stock, this increases the shares outstanding, making your shares less valuable. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow at some point, you don't have much of a business, because you cannot rely on debt and equity financing to run your business in the long term. This company, of course, has negative operating cash flow each year. You could think of operating cash flow as net income converted to cash. Net income is your accounting profit and loss. It's not actual cash. And the way you calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. Let's look at 2019. They had negative $20 million of net income. Then we have to add back $800,000 of depreciation. That's a non-cash item that brings down your net income. We have to add back $2.5 million of stock-based compensation, $790 million of other non-cash items. Even though they reported a $20 million loss, they actually lost $15.6 million of cash flow. Let's look at the capital structure. $53 million of equity, $1 million of debt. They're 97% equity, 3% debt. And their WACC is 13.8%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.8 billion. We divide that by 947 million shares. And we get a calculated stock price of $188. They're trading at $212, so they're trading at a 13% premium. It's a sell according to the model. It's almost impossible to value a company that has negative free cash flow. So I had to estimate their future free cash flow based off of analyst estimates. I also had to base it on how successful Truforma would be, as well as their other products. Anything can happen in the future. They could generate much more free cash flow than this, or they could never generate positive free cash flow. No one can predict the future, especially with a company that doesn't have much information to go with. This is the stock price since it IPO'd, so it's almost at where it was trading at when it first came out. The stock got really low at one point, but it's really been driven up lately. Investors are pushing the price up out of pure speculation and also fear of missing out on a big stock. The stock has gone up over 800% in the past 52 weeks compared to the S&P 500, which went up 17%. The 52-week low was 6 cents, the high was $2.91. The stock is trading way above its 50-day and 200-day moving average. This is a really liquid stock. 70 million to 180 million shares are traded each day. Of the 947 million shares outstanding, 600 million are on float. 6% of the shares on float are shorted. If you invested $10,000 when this company IPO'd, you'd be at $7,800 today. That's an annual loss of 7%. Gerald Zelensky is the biggest shareholder at 4%, then Vanguard, Sabby Management, Cambridge, and Rowe Family Trust. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio, but we can't look at their price sales ratio because they have no sales. Price to book is stock price over book value per share. They're at 37.6. So investors are paying about $38 for $1 of equity. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities with their current assets. Their current assets are $52 million of cash and $129,000 of receivables. The company seems to be well capitalized since it has so much current assets on its balance sheet. It has $51 million of working capital, so it should be able to get through the next year or two without taking on any more debt or issuing more stock. The best way to look at ratios is to compare them to similar companies. I've done videos of 16 companies in the same industry as Zomedica, and if Zomedica has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in all the price multiples. They have a really high current ratio. They have a bad ROE, but it's a little better than average. They're really low in debt at 3%, average is 35%, and their market cap is $2 billion, average is $7 billion. So to summarize, I have them trading at a 13% premium, but this is a really risky stock. It hasn't made any money yet. Although the stock can be huge one day, it may never go anywhere. Some people have made a lot of money on the stock already by buying low and selling high. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.